Sure, I'll record it. Okay. I don't want this. Can you guys see the whiteboard?
Yes,
Yeah,
we
I
can.
can see that.
Yes, we can. I think we can also interact with it, actually.
Okay. I don't want it. Okay. I want to go to something else. All right. So we're going to do acknowledgements, contents. Come on, come on. I don't know why it's not opening. It's going here. Here we go. I don't know why nothing's working right now. Okay. Well, let's just look at it here. Okay. We'll do it this way. All right. So let's take a look at the screen, and I want to do, I forgot. Oh, thank you for just kidding. All right. So we looked at, can you guys see my screen now? Yes, I think you can. All right. So this is chapter 1. So I just want to kind of briefly talk about just sort of areas for you guys to focus on. And then I want to look at the, oops, I lost it. If I lost that screen, I'm going to be very angry. Yes, I did. I want you guys to identify areas where the practice exam is testing you. Okay. Okay. Back to this. Launch. I just got a new computer today, so apologies for this. I got a new computer a few weeks ago, and now I got another new computer. Okay. Here we go. All right. Okay, so let's look at the learning objectives. Chapter 1 was all about what's the form of a business? What are the 3 forms of a business? Put it in the chat. What are 3 forms of a business? Or actually, what business form do we work with all quarter? Maybe that's a better question. Of the 3 forms of business, what business form do we work with? And where did we get, you guys would have gotten your financial statements from these types of businesses. So what's the business form? Everybody went really quiet. It's okay to say, I don't know in the chat. There we go. Joe, you're correct. Corporation. Okay. So, but there's not 3 activities: finance, investing, and operations, and then the statements. You got a brief introduction to the statements, and you had to prepare them in chapter 1. Okay. So then let's go back to table of contents and look at chapter 2.
But the corporation is one of those 3. I forgot the 2 actually.
Sole proprietorship and a partnership. But we don't work with those business types at all, Joe. We just work with the corporation.
Okay,
So what is
no
it?
problem.
So the corporation has so the corporation has limited liability. So okay. So chapter 2, we really did the classified balance sheet. Okay. That was a big deal, and you need to know that. And we don't really change anything in there. We keep with that balance sheet forever. So that's the balance sheet from chapter 2 on. In chapter 1, we just kind of had assets, liabilities, stockholders' equity. Now we have these categories. Okay. So let me just do it this way. Okay. These guys are on the right side, right? They're the liabilities, current and long-term, and stockholders' equity. But in the assets, you have 4 categories: current, and then in between current and property, plant, and equipment, we have LTI, long-term investments. Okay. And why is it in between? Because current assets you're going to turn to cash the soonest. All right. Property, plant, and equipment, you're not going to turn it into cash. They have, if you do, they have a long life, 3 years, 5 years. But long-term investments, if you need extra cash, you're going to cash out your long-term investments first before you start selling your land and equipment that you're using in your company. And then after property, plant, and equipment is intangible assets. So I don't know, CLPI, if you can make a acronym with that, Clippy or something, I guess. Okay. Then we started using ratio analysis. And this is theory that we're not going to have theory on the exam. Okay. So let's go to chapter 3. Okay, so no journal entries, chapters 1 and 2. Okay, we have no journal entries. Okay. And then in chapter 3, we start in on the journal entries. Okay, so here we are with chapter 3. And we have, this is where I started asking you guys, was there an exchange? Was there an accounting event? You know, you might say, oh, there was a business event, but there was no accounting event. An accounting event requires some form of an exchange between two accounts, right? So really understanding. So for example, if I said to you, the business bought a car, but they haven't paid for it yet, but they have the car. Is that an accounting event? The company bought a car and has the car and will pay for it in 1 month.
But it is the accounting event for those people who selling the car.
Well, let's start with the company first, and then we'll answer the other one. So the company bought a car and has the car. They're driving the car, and they will pay for the car in 1 month. Is that an accounting event? And if so, why?
I think it is,
I think you're right, Joe. Why?
because the car is delivered and they already got the car.
Okay, that's good.
And also they will pay in 1 month, which is account payable.
So it would be debit equipment, credit accounts payable for the car. So it's an exchange because the company has the car and the company owes the money. So now the car dealership, they're going to say what? They're going to say accounts receivable and sales. So they would record it as also, and they'll also say cost of goods sold and inventory. Okay. All right. So chapter 3 is where you guys first see journal entries, debits and credits. And we do more of those, what do you call them? The algebra problems where, you know, assets go up, stockholders' equity goes down, what happens to liabilities, that kind of stuff. So you learned how to make journal entries. You learned how to post to T accounts. You learned how to create a trial balance. And the trial balance is in the same order: cash, accounts receivable, prepaid expenses, and so forth. Okay. All right. That's chapter 3, but let's take a look at the back of chapter 3. Let's see. I think it will be here. Let's try it. So you're going to analyze all the transactions, and I think I want to say there's a nice big list of all the transactions. So what I always tell students is drill on the journal entries, because here we go. This is a good list. So this is under illustration 3-32. And the 3 is the chapter name. Shows all the chapter 3 JEs in one place. Okay. So here it is. always from the point of view of the company, right? Company gets cash from the stockholders, the company's cash goes up. And of course, common stock also goes up. Company issues a note, company buys equipment. Company gets an advance payment from a customer. Cash comes in, but they can't call it service revenue because they still owe the service in the future. If they get cash for providing service, then you do cash service revenue. I wish that you could print this out and just use it for practice. So I would put lines under here to show that these are separate journal entries. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And in my course pack and in my PowerPoints, I think I had 13 journal entries. So you want to look at all of them. Okay. And then it shows how they look here. Okay.
Judith,
Yes.
do we have to do the explanation for the final?
No explanation. No, none, not for exams.
Okay.
Good question, though. Okay. Oops, let's see. Let's go to chapter 4. And then chapter 4. So 4, 5, and 6, things get a little more complicated and we start building on what you've learned. And so we talk about these principles in accounting that are really important, and it's revenue recognition, expense recognition. And so revenue recognition is where we say you must record, you must recognize by recording the revenue in the period, the month or the year in which the revenue was earned. Okay, so if you, it doesn't matter if the customer paid you or not, if you provided the service or if you gave them the car, you know, you sold them the car, you record the revenue at that moment. That's really important principle in accounting. And then you also must record any expenses that helped create that revenue. Okay, so, and that's where we get into the 7 adjusting journal entries. So we have prepaids, also known as deferrals. We have 4 prepaid journal entries and 3 accrual journal entries. The prepaids mean there was an earlier transaction that created an asset or a liability that we're now converting into revenue or expense. The accruals, there was no early transaction, but you're booking entries to recognize revenue or expense. Okay, so it's 7 transactions. And then we're gonna see if I can show you these. Let's see if I can. This is summary. Oh my gosh, is it pouring outside? Yes, it is. Boy, what a surprise. Okay. And no, I don't want that one. I want a summary of all those. Here we go. All right. So this is illustration. Illustration 4. And that the first number there is the chapter 4-25. Show all the chapter 4 journal entries in one place. So illustration. So here we have, so the 7 adjusting journal entries are going to be supplies, insurance, or rent, where you prepay the rent or you prepay the insurance. Of course, depreciation, and then unearned revenue. Okay, or unearned service revenue. Okay, so that's all good. And then the next 3 are the accruals, where you accrue revenue. You say, oh, we performed the service, we just haven't billed the customer yet. We were recognizing interest expense. We're recognizing salary expense. So we owe salary. Okay, those are the accruals. Okay. Any questions on these? So again, so about 13 journal entries from chapter 3, if you include the ones in my PowerPoint. In chapter 4, we have 7 adjusting journal entries. Okay. Then we move over to the closing journal entries. Okay. And we have, here they are, illustration 4-32. Okay. All right. First, we close out any revenue account. If we have 2 revenue accounts, you'd say service revenue, sales revenue, and then income summary. Under, we close every single expense account, and don't forget depreciation. And then debit income summary. Now, in this example, you had 10,600 of revenue, 7,740 of expense. So you know you made a profit. You can take the difference here, and that's your profit. And you credit retained earnings for the profit and clear out the balance in income summary. So it's a little bit of an extra step there. You could just do service revenue, retained earnings, expenses, and skip entry 3. But most accounting departments prefer 4 closing journal entries because you actually have a journal entry for profit. And then the final journal entry is to close the dividend account. Okay. So now we're up to 4. All right. So then we go, any questions on those adjusting journal entries? Okay. So I just want to do this review, and then I want to go and see if you guys want to walk through any questions on the practice exam. Okay, let's see if we can go all the way back to here. So in chapter 5, we have very many journal entries, and I know it's a lot, and they're summarized in the back. Let's see, what section are we in? Appendix 5A has a summary of okay, so let's count these journal entries we've got here. So we've got this first set is this first box and then the second box. So we have purchase transactions, and the blue that you see here is perpetual, and the red that you see here is periodic. So 1, 2, 3, 4, 5, 6, 7 journal entries for the purchases. You buy the inventory, debit inventory, credit accounts payable. You return, or you pay the freight on the inventory, that you charge everything to inventory with perpetual. You return the inventory. You just reverse the first journal entry for accounts payable and credit inventory. And then when you finally pay the bill and you get that discount, that 2% discount, you credit inventory. That's 4 journal entries. And then what's complicated about perpetual is when you make a sale or when you make a return, when you make a sale to a customer or a customer returns to you, it's a 4-line journal entry because you are tracking the inventory perpetually. Okay, so we've got accounts receivable, sales revenue. Now we've also have debit cost of goods sold, and we have debit inventory. I'm sorry, credit inventory. So we're increasing our cost of goods sold, increasing expenses, and decreasing the inventory. We're shipping the inventory out. Here comes the return. We use sales returns and allowances. Credit accounts receivable, we're reducing what the customer owes us for the amount of the return. And then debit inventory and credit cost of goods sold. Okay. And finally, when we get payment, we debit cash. We debit sales discount because it's less cash because we gave that customer a discount, and we credit accounts receivable for the full amount. That's perpetual, and that's 7 perpetual journal entries. Okay. Okay. On the periodic side, we don't use inventory. You don't see inventory anywhere here, and you will see it at the very end when we calculate inventory and cost of goods sold. We have to actually physically count the inventory to know what's in there. So in the meantime, we use purchases, freight in, purchase returns and allowances, and purchase discounts. Okay. So very similar journal entries on the other side, accounts payable, cash, accounts payable, but it's those 4 titles that are new with periodic. And then for the sales transactions for periodic, they're identical. We just do not have the cost of goods sold and inventory in there, or the inventory and cost of goods sold, because we're not tracking inventory perpetually. So we have another 7 journal entries there. And in this chapter, what else did we add? We added the multi-step income statement. So let's see if I can, and you're not responsible. You do need to know how to calculate cost of goods sold. And let's see if we can, here we go. Cost of goods sold, beginning inventory, plus purchases, less returns, less discounts, plus freight equals goods available for sale. And you don't need to have all this memorized in this format. This is what I want you to know how to do. And this is how I tested you on the last exam. I want you to know. Hang on, I'm just going to highlight this. Okay. So here's the 5 things: beginning inventory, plus purchases, less purchase returns, less purchase discounts. And remember, it's purchase returns and purchase discounts, plus freight. Those 5 things equal goods available for sale. And then you subtract ending inventory. You say, what's left? Only have 40,000 left. Therefore, I must have sold $316,000 worth of inventory. Okay. I want to be able to know how to do that. And then the other thing here is the multi-step income statement, which you guys did really well on the last exam. So you just need to make sure when it comes to statements, you need to know how to do the classified balance sheet and the multi-step income statement. So we're looking for net sales. We're looking for cost of goods sold. We're looking for gross profit, also known as gross margin. Expenses, we're looking for operating income, and then those other revenues and other expenses, and then your income tax. Okay, so that's chapter 5. All right. And that should be fairly fresh for you guys, hoping it is. And then chapter 6 is FIFO, LIFO, and average cost. And determining inventory, specific identification, FIFO, LIFO, average cost, and then lower of cost or market. Okay. And then chapter 7. So you have had some homework questions about internal control. And so we're not going to focus on that for the final exam. It's going to be more the principles of cash account and bank statements and reconciliation of that. Okay. All right. And then the final step in the bank reconciliation is the correcting journal entries. So let's look at that. Here we go. So we did the bank reconciliation, and then you come up with the bank reconciliation. You do start with a balance per bank, start with a balance per books, and make the adjustments. And then the final step in all those adjustments is the correcting journal entries. And where did it go? Did we get a list? Those, I don't see a list of the correcting journal entries. Oh, here they are. I see it. Okay. So here's the correcting journal entries. It can be 3 or 4 journal entries. So we'll say 4. Okay. All right. So I'm adding these up, and I'm coming up with chapter 1, no journal entries. Chapter 3, 13. Chapter 4, 7, adjusting. 4, closing. Chapter 5, 7 perpetual, chapter 5, 7 periodic, if I can spell. Chapter 6, no journal entries. Chapter 7, 4 correcting journal entries for the bank statement. So what is that total? It's a lot. Okay. I'm coming up with 21, 11, 12, 2, 3, about 42 journal entries. Does that sound right? Anyway, it's a lot. It's plenty. So that's a lot of flashcards you guys can make over the weekend and just use it for studying. But let's look at the practice exam and see what we have here. So let's see. All right. All right, do you guys have any particular questions on the practice exam that you want to go over, or any particular? So here we say perpetual, that's chapter 5, right? So, and then journalize the transactions. Here we say periodic, that's appendix 5A. I can spell right. And then complete financial statements. Multi-step income statement is chapter 5. Classified balance sheet is chapter 2. And adjustments are going to be chapter 4. Question 4, chapter 4. That doesn't like that. Okay. And bank reconciliation is chapter 7. So at the very beginning of the exam, oh, and here's the algebra stuff. General algebra. And then chapter 7 is the periodic journal entries. Okay. And then it just starts repeating. Everything starts repeating and you get more practice. And the practice exam is quite long. So you need to know that there's a lot of problems you can practice on. Okay. All right. And do you guys have any specific questions you want to go over, or just kind of want to?
Oh, Julish, you gonna make your own final, or you gonna share the final with other teachers?
I have not shared my final with other teachers,
Oh, I got it. Thanks.
but our finals are very similar.
Okay, no problem.
Is that good or bad?
Oh, that's good for me.
Why is it good for you?
Cause I know you typically don't put those like the concept question in the exam. Cause I hate those concept questions. I always struggling with concept.
It is hard because that's where you really understand the material, but I agree, it can be hard. Okay. All right. So Michelle wants to do problem 5. Okay. So maybe I'll bring up an Excel spreadsheet so make it easier. Okay. So, and can you see both of my spreadsheets? Let's see. Can you see both spreadsheet and the practice exam?
Yes.
Okay, thanks. All right. So Michelle, when you start one of these problems, I mean, it's a good problem to go through because it's a lot of dates that are going on here. So, and the dates are really key. So I'm just going to write company. So let's acknowledge the question. So let's go to the end here. Prepare a bank reconciliation as of October 31st. And that's important. That's going to inform us. So So we're gonna say, so we're gonna start, I usually always put the bank on the left and the company books on the right. It doesn't matter, it's whatever you're comfortable in. But that's how I do it, I guess, because it's alphabetical. Okay. So we always start out, what is the balance per bank? So, and then it's gonna be the same over here, balance per books. Okay. Like so. Okay. So this is going to be the bank side and this is going to be the book side. All right. So balance per bank, we need that number. What other numbers? Let's not look for numbers yet. Let's talk about the format. What do we add to the bank balance? What do we add to the bank balance? It's stuff that the company has booked as an add that don't show up on the bank statement yet. So what would be what's the category of things that the company would add? Good, deposits in transit. So you can do like this. I don't really care if you want to do it like that, or if you want to spell it out and say deposits in transit, or even abbreviate it. Okay. And then what about subtract or less? So what would we subtract from the bank balance? In other words, things we've already subtracted from the company books, but things that haven't cleared the bank as a subtraction. So yeah, it's going to be outstanding checks. Make it bigger. Okay. All right, so that, and then it's going to be, we're going to add whatever those are, we're going to say adjusted balance per bank. Okay. So let's look for, what's the bank balance here? Selma, that's correct. Yeah. What's the bank balance as of the bank statement? Let's see. Oh, that's funny. Got the wrong solution. It's for the other question. Let me make sure I have the right one, but yeah. So the cash balance per books is this. So we could put that on the book side, 8736.01. And then do you guys have the same one? Do you have the same exam I'm looking at? Because I have a different exam here. Let's see. And the cash balance per bank is 11951. They've got it in a couple places. They've got it right here, and they've got it right here. Okay, and we'll fix that formatting here. Nope, I want that. Okay. All right, so we have to figure out what are the deposits in transit for this company. Okay. Here. Here we go. I got it. I'm just out of order. All right. So we have some language here that's confusing. So we say the balance per books for Fegan is this, according to October 31st. The following checks and receipts, that means money coming in from customers, were recorded for the month of October 2011. So here's all the checks and here's all the deposits, the receipts. Okay, and here's the dates. Okay. So what the company does is it looks at the bank statement and it says, let's make sure all the checks we wrote cleared the bank. And we're just going to go down and look. So we're going to say check 17. Here it is. It cleared the bank. 372.96. It's good. It's not outstanding. It cleared the bank. Check 18. 780.72. Well, there is a check 18, but there's an error there. Okay, so we're going to hold that one, and we have more information down here on check 18. So let's wait on that one. Check 19, 157. Check 19, 157. Check 20 did not clear the bank. It doesn't show up anywhere. So that's going to be one of our outstanding checks. So we'll put it here as check 20, and we'll show it here as check 58750. Okay. Check 21, 234.15, cleared the bank. Let's not worry about this yet. Let's just focus on the checks. Check 22 does not appear to have cleared the bank. Check 20, oh yes, it did. It's over here, 578.84. Check 23 does not appear to have cleared the bank. Okay, so we're gonna do, and that's gonna be, okay. All right, and then check 24, 921.30 cleared the bank. Check 25, 246.03 cleared the bank. And we've already accounted for this one. So we've looked at all the checks on the bank statement and we're good. And so these are our outstanding checks. But let's look at the deposits. So these are the deposits, 1, 2, 3, 4, 5, and then we have a couple of odd items here. We're going to come back to them. But let's just look at the deposits. So we have, there's no comment on this first deposit for October 1st. It's not listed here in the company books. That probably means they deposited it in September, but it didn't. They collected it in September. They've already booked it in September, but it was in transit at the end of September. So we're going to assume that if there's no other information. Then we have October 8th for 843.86. That cleared the bank. October 21st, 941.54. That cleared the bank. October 27th, 808.58. That cleared the bank. And then this last deposit, 967 on the 30th, did not go to the bank. So that's going to be our deposit in transit. Okay. So we're going to add that and we're going to subtract these. Okay. Let's just show that as kind of. So these are going to be added. Now, what I want to point out is we're not done. We've got lots more to do on this bank reconciliation. But these odd items, NSC, CS, CM, they're going to be on the book side because they've already been recorded by the bank. So the bank, there's nothing else to do here. So let's read our notes here. Check 18 was correctly written for 708.62 for payment on account. So what does that tell us? The check was correct. It cleared the bank correctly, 708.62. So we don't need to do anything as an error with the bank. However, on the books side, we made an error. So that's going to be a correction in that column for the books. Okay. All right. So let's finish this part of the bank statement. So can you guys calculate what the adjusted balance should be for the bank and put it in the chat? Take a minute and give me the correct balance here. The adjusted balance. So I want this number right here. Michelle, you are correct. Anybody else? So we're going to take the beginning balance. We're going to add 967 and subtract the outstanding checks, and we're going to get this balance. Dylan, Luca, Joe, Sabrina, Victoria, Salma, you're correct. Got 2 correct answers. Anybody else? Sabrina, you are correct. So we're going to take our beginning balance. We're going to add deposits in transit. We're going to subtract each of the outstanding checks, and we're going to get an adjusted balance per bank. Okay. So that's our goal here, folks. We are really hoping that we get that same 10,643.01 on the book side. Okay, so we're going to start with book side. Now we don't, anything we used on the bank side, we're not going to use on the book side. You can only be in one place. Okay, so what we do on the book side is we look at the bank statement and we say, is there anything here that we haven't recorded? Okay. So we know we have this error. We're going to have to fix the error. And then here's the explanation. The credit memo, $2,100 CM, is for the collection of a note receivable, including interest of $60, which has not been accrued. Okay. All right, so that's a lot. What does that mean? The credit memo includes the $60. So when you're going to see these note receivable collection, accounts receivable collection, whatever it is, you're bringing money into the bank directly. You're not, the customer is not sending a check to the company. They're bypassing the company and wiring the money straight to the bank account. Okay. When you see that word including, it means the number includes, that's the total amount. Okay, so that $2,100, is partly for the note and partly for the interest. So we're going to write it up that way. We're going to say note collected. And I'm going to put this, the solution lumps them together, but I'm going to put it separately. I'm going to say note collected and interest collected. You could have interest paid, but in this case, it's interest collected. Okay, so let's do this first. Let's say add, and let's just do it like this. Okay, so we're going to add note collected, and yes, you can write collection of note. I'm not really picky on the bank statement. So we know the total is 2,100, and we know they collected interest of 60. So 60 plus whatever has to equal 2,100. So that's going to be 2040. All right. Note and interest. Okay. And then the question is, do we have other things? So let's read on. So that deals with the CM. So we don't have any other deposits here. Service charge and NSF are all subtractions, okay, because they're under checks and other debits. Deposits are under your bank statement receipts, the deposits. Okay, so let's go back to the error. Check number 18 was correctly written for 708, but the company deducted 780. So how much of an error is that? The company wrongly, so the company, let me just write this up, company error. They deducted, yes, you can, Michelle, you can combine them, the interest and the note. The company did this, the company did 780.62. The company should have done 708.62. So how much of an error? What's the error here? Can you put it in the chat or say it out loud? What was the error? How much was the error? $72. Good. So the question is, what do we do with the 72? We got to fix it. So we subtracted too much from the company books. So what are we going to do with it to correct it? Do we add it back or do we subtract it? Good, Sabrina, yes. Anybody else? So let's think about this. They should have done this. So I'm going to put that down here. So let's say they made an error of $72. This is an easy way to do this. So if we correct the error, Sabrina says we add 72. That's how, in this example, there was an error and they over deducted. So let's just see what we get here. We'll just add these, the original entry and the correction, and you'll get 708, okay? That's a good way to test this. It's like, maybe you got it wrong. If you thought you should have subtracted it, if you said, oh, I think you should subtract it, well, that doesn't get you to the right number. The right number is 708, so you can add it. Okay, so we're gonna correct an error, and it's check number 18. We're gonna add 72 back, okay? All right, so that's the adds. So what are the lesses? We gotta deal with the NSF check, and we gotta deal with the service charge. So NSF checks, we subtract them, and that's going to be 230. And the service charge, that's a big service charge of 35. And then we're going to have, so we can do this. Let's see. No, that's not going to work. It's a different formula, but I just wanted that. So we're going to take 8736 plus 2040 plus 60 plus 72 minus 230 minus 35, and we got the same number. And so that means we're reconciled. Okay. Does that make sense to you guys? Okay, so now you guys have to, I'll say this. Now you have to make the correcting journal entries. I can do this. Okay, so you have to make correcting journal entries for 3, 4, 5 transactions. Okay, so let's do that. Okay, so this is what you have to do for correcting journal entries. You're going to make 1, 2, 3, 4, 5, or you could combine the note collection one. So let's do our first journal entry. We're increasing cash. So if the best you can do on the correcting journal entries is half a journal entry, do it. So first journal entry, number 1, I'm going to debit cash for 2040. Okay, and then I'm going to credit. In this case, the problem tells me it was a collection of a notes receivable. It's bigger.
If we already combine the note collected and the interest collected from the book, then for the journal entry, can I just combine it in one journal entry?
You sure can.
Okay.
You're going to do it. So I'll show you these two. So this one, we got cash. I'm going to show you these as separate, and then we're going to show it as combined. So you can do it like
And
this.
we can choose to do either of them, right?
Absolutely. You always can. Yeah. So if you were to combine these, it would look like this. It would look cash, 2100, note receivable, and interest revenue. Okay. So you can do it as one entry, or you can do it as 2 separate entries. It's okay with me. All right. All right, so let's do the next one. So you can see what's happened here. We're just saying debit, debit, debit to cash. Okay, so journal entry number 3, we're going to debit cash again for $72. Now, this is where it gets tricky. The company wrote a check. And so the question is, what do you do with that check? When a company records a check, they owe somebody money. So that means they had accounts payable. So if we made an error, we're going to have to hit accounts payable again. If it were an error with a customer's check, we'd use accounts receivable to correct the error. But this is a check the company wrote. Okay, so we debit cash. So all of these are debit, debit, debit to cash. These are going to be credits and credit to cash. Okay, so let's do the cash first because it's easier. There's cash. I'm just going to set these 2 journal entries up. And cash. Okay, so this is what I'm talking about. If you don't know what the heck to do, you know what to do. You should know what to do to cash. So we're going to credit cash for $230. And we're going to credit cash for $35. Okay. And that may be the best you can do. But let's look at the problem. NSF check. NSF check came. Let's go read the problem. An entry had not been made for the NSF check. The NSF check was from S. Long, a customer in settlement of an accounts receivable. Okay, so the company would have deposited that check. The bank, maybe in the previous month, and then the bank tried to get the money from the customer's bank, and the customer's bank said, not sufficient funds. We can't pay that check to you. So the company reversed that deposit. So the company has to reverse recording that deposit and it goes back into accounts receivable. Okay. So NSF checks, the journal entry is always the same. Put it back into accounts receivable and credit cash. You're reversing an earlier deposit. Service charge, you have your choice, service charge expense or bank charge expense. Either one of those is just fine. Okay. All right, so that's that problem. If you want to look at a problem that's, let's see, do we have other ones in here? I think we have one that's a little bit shorter. Let's see. Yeah, let's do, you guys want to do another one? Or are you good? This is a shorter one. It takes a little less. Yes. Question 14, Sabrina says. So this one, let's go to question 14.
I want to ask the cash balance is for book or for bank for question 14.
Let's look. Question 14. The cash account shows a balance of $45,000 before reconciliation. The bank balance.
So that is for bank balance.
Does not
Cash
include a deposit of $2,300. The cash account means the books. Yes.
Oh, the books. Okay, so if it's for bank, it will show for bank.
Yeah, the bank statement doesn't include deposit. The correct balance in the cash account. So they're just asking. So that's, you're not doing a full reconciliation on this one. You're just doing the book side.
Okay.
So can you do this one?
Yeah, I'm just wondering if the cash balance is for bank
Yeah.
or for book.
Yeah, no, I understand it. A lot of this is just the vocabulary. It gets tricky. So 45,000, bank statement doesn't include a deposit. We don't care. We're only doing the book side, so it doesn't matter. Bank statement shows a collection and a customer's check was returned. And then you have another error and another error. So all of that's going to be on the book side. Can we do a little bit of LIFO, FIFO? Are you guys comfortable with that? We're kind of running out of time, but if you want, I'll stick around and do a last question or two. So what would be your last choice for things to go over? All right. Let's see if we can. Here we go. So when we do LIFO and FIFO, we use the periodic system. You can also use perpetual, and in the, I believe in the appendix. Well, this is not periodic. This is chapter 6. This is not chapter 5, it's chapter 6. And so you want to be, so you're going to get information like this: inventory, purchase, sales, purchase, sales, purchase, sales. And so the only reason we look at sales is we don't care about the selling price at this for LIFO, FIFO. Okay. We just want this, we just want to know how many units were sold. So the terms FIFO and LIFO refer to the calculation of cost of goods sold. Okay, so let me write it up here just because I think it's easier. So your first step in all these problems is to come over here. There's not a lot of room here for you, and calculate extended cost. Extended cost means units, number of units times cost per unit, and then that's extended cost. So let's set this up. Let's say beginning inventory, and I don't want it for the sales. I just want it for the inventory and the purchase and the purchase. Okay, and we're going to have units, cost per unit, and then extended. So beginning inventory was 30 units and the cost was 105. And just be really careful you keep units and cost separate in your mind, because if you don't, you'll mess up. Okay, so then we have 30 times 105. So that we call that the first cost layer here. The first cost layer is 3,150. Then we purchased 280. I'm just going to write all the units down. And then we purchased 190, and then we purchased 90. Okay. And I want to do something here. See if I can. Get the dates here. I don't know where the dates went. Maybe they're already there. Here they are. Okay, let's do it like this. Okay, so these are, this is important. The dates are actually important. So let me put the dates in 2/1, 2/3. And so you can get an idea that some time has passed. And I think it's important for you to also recognize whether costs are going up like they are right now, right, in real life, or costs are going down. So that 280 purchase was 130 per unit. The 190 purchase was 135, and the 90 purchase was 145. So let's just be real clear here that those are all the cost price. And then our extended cost here for 280 at 130 is quite a bit more. It's $36,400. All right. And then for this next purchase, it cost 190 times 135 is 25,650. And then our last cost layer is 90 units times 145. Okay, I'm going to ask you guys a question. Are costs going up? Is this inflation or is this deflation? Inflation, costs are going up, or deflation, costs are going down? Salma, you are correct. All right, so then the next thing you need to calculate is goods available for sale. I'm just going to abbreviate that. Goods available for. Okay, so we're going to add up all our units. And So we had 590 units, okay? We don't add up our unit cost. That doesn't make any sense because we bought at different quantities. So the weight is different. So we're gonna, but we do add up our total amount that we paid. So we're gonna add up all of this. Okay, so goods available for sale here is 78,250. Now we're gonna go back and look at what was sold. So how many units were sold? So we have to add up 260 plus 180 plus 110. So we sold 550 units. For right now, we don't care about the selling price, okay? So that means ending inventory is our goods available for sale minus our units sold, okay? So that's going to be 40 units in ending inventory. All right. Okay. So now LIFO, FIFO, average cost. I think I asked FIFO, LIFO, and average cost. Okay. So let's start with FIFO. So you're going to, the method is, I know the book teaches this backwards. They say do ending inventory first and then just back into the other one. But in fact, cost of goods sold using FIFO, the whole method, FIFO, LIFO, is referring to how we calculate cost of goods sold. So we have to add up to 550. That's the magic number. And so we go cost layer by cost layer. So we're going to lift this first cost layer. That's 30, but that still leaves us with 520. We're going to lift this second cost layer. That's 280. We still need to go. We're going to lift that third cost layer because what are we saying? We sold the first item we bought is the first one out. That is how you guys should use, that is how you guys should do your refrigerators, right? You should say, we put the milk in. If we buy a second carton of milk and we still have milk in the first carton, we move that new milk to the back. The first one that went in the fridge is the first one we drink. Okay, so let's check here. How many do we have? We're still at 500. So we got to go into this last cost layer. Yes, and we're going to go in, we need 50 more. So we're going to go into this last cost layer. I'm going to copy it, but I'm going to change the numbers. And I only need 50 out of that cost layer, okay? And now I've got all my cost here, so I got to add it up. Okay, I'm going to add it up, and I'm going to say cost of goods sold using FIFO is going to be 72,000. 72,450. Okay. Ending inventory using FIFO is going to be that 50 units left over. In fact, sorry, 40 units left over. So I'm going to use this last cost layer because I've exhausted the earlier cost layers. And it's going to be 40 units. Okay, so ending inventory is going to be 5,800 using the FIFO method. And cost of goods sold using the FIFO method is going to be 72,000. Okay. Does that make sense to everybody? So FIFO and LIFO refer to how we value cost of goods sold, and then ending inventories, whatever's left over. Okay. If I want to do, so now the question is, how do we do LIFO? Well, we do the same thing, but in reverse, right? So we're going to say, so this was FIFO. Now we're going to do LIFO. We're going to do cost of goods sold. But now we're going to pull from the oldest cost layer. I'm sorry, the newest cost layer, last in, first out. And we're going to exhaust the cost layers going from current cost to older cost. So again, we have to add up to 550, but we're starting with that 224 purchase. Okay. Then we've exhausted the 50. And we're going to go into the 210 purchase. And we've exhausted that, and we're going to go into the 2-3 purchase, but then we're going to have gone too far. So let's stop there and let's do our total. Now we're at 560, so we need 10 less here. And there we are at 550. So cost of goods sold using LIFO is 73,800. Ending inventory using LIFO, again, is going to be what's left over. So that oldest cost layer. No, this cost layer, but only for 10 out of this cost layer. And then all of the earlier cost layer. And you can see these two are going to add up to your 40 in ending inventory. And that's going to be okay. All right, that should make sense to you. So I like to do it the long way. I like to show cost of goods sold first. I know the book does it the other way, but for me, if you do cost of goods sold, that agrees with the name of the cost method. First in, first out, last in, first out. Okay. Average cost is super easy. You go back to your numbers at the top. You go back to goods available for sale, units available for sale, and you say, what is average cost per unit? It's going to be your total cost divided by your total units. And you're going to say for every unit, this is your average cost, 132.63. Then you're going to come down here for average cost. You're going to say cost of goods sold, ending inventory. You're going to say 550 and 40, and we're going to use that cost up above. Uh, 132.63, and then we're going to say in many ways, average cost is the easiest one, but it is not the most popular one. So average cost using ending inventory. Average cost would give you cost of goods sold and ending inventory. Okay. All right. Okay. So the question asks you cost of goods sold, ending inventory, and then it asks you gross margin and gross margin percent. Can you guys give me that? So in order to do that now, and only now, do we need to know what our sales were. So let's go back and look at our sales transactions. We had 3 sales transactions. So let's write them out here. So we had unit, price, and extended price. So we sold 260, we sold 180, and we sold 110, and our price was $255, $230, and $298, and our extended. So tell me to slow down if you have a question. Okay, so now we said this is our total. This is our total selling price. So this was our total sales. So what is gross margin using FIFO? What is gross margin using LIFO? And what is gross margin using average cost? So we're going to use this number, and for cost of goods sold, we'll use the different methods. Some of you could be right. Let's take a look here. So let's do gross margin. Now let's do sales, COGS, GM. And then let's do FIFO, LIFO, and average. Okay. So sales is going to be same number for everybody. Except you can't see it. But for cost of goods sold, we have to go grab the FIFO, LIFO, and average cost. Okay, so let's do it. So for cost of goods sold for FIFO, it's going to be 72,000. For cost of goods sold for LIFO, it's going to be 73,000. Whoops. And for cost of goods sold for average cost, it's going to be 72,945. Okay. Gross margin is the difference. So it's going to vary depending on your cost method. Because remember, with FIFO, the cost, with inflation, FIFO is going to have the lowest cost of goods sold because costs are going up and you're using the oldest cost. LIFO is going to have the highest cost of goods sold, and average is always going to be in the middle. Okay, so how do we do gross margin percent? It's going to be gross margin divided by sales. And let's turn that into a percent and use 2 decimals on percents. Okay, and 68,030. Good, you got that right, Selma. And does that make sense to everybody? So how do we calculate this? All right, I will see you guys later unless you have any more questions. No, we're not going to do essays on the final, Michelle. Thanks for asking. Any other questions? Thank you. You're welcome. You can always email me questions. The final, what time is your final? Let's make sure you're all signed up. If you guys forgot to sign up, I'll be sad. Let's see, final exam. Oh, we still have people that haven't signed up. Is anybody in the room that hasn't signed up? Let's see here now. Michelle, you're signed up. Nope, you guys are all good and signed up. All right, I will see you guys later. Take care. Bye-bye.
Thank you so much, Professor.
You're so welcome. Have fun next. Are you going to summer school or taking it off?
I'm going to be on vacation right after the final.
Yay, where are you going? Someplace warm, I hope. It's freezing here.
Yes, it is very warm. It's like I can say it's hot, not warm.
Where are you going?
I will
California?
go back to my hometown in Vietnam for after probably 6 years.
Oh my goodness. Wow.
Yes.
Everybody's gonna make your favorite foods. That's so exciting. And will you be back in the fall or no?
Yes, of course. I will be back in the fall.
That sounds great. That sounds really nice. Oh, that's the second person I've talked to that's going back to Vietnam, and they're
Oh,
so
really?
excited. The other one, I don't know. Did you go to alumni night, Michelle?
I haven't got a chance because my mom was in clinic on that day, so I
Okay.
have to take care of her.
One of my alumni is from Vietnam, and she was going back for 2 months. She said,
Oh,
couldn't wait to go back. So, and now you're going to ask me where she lives, and I can't remember, but she did tell me. She did tell me. Let's see if I can find it for you really quick. Maybe you'll know the place. She said, let's see. Hang on. My family lives in Canto, South Ho Chi Minh City.
oh, I see. I know. It's like a province
She
in.
said it's very beautiful.
Yes.
All right, you have a wonderful time.
Yes,
and
thank you so much. Have a
All
nice
right.
day, Professor.
You too. Goodbye. Goodbye, Joe. Goodbye, Sabrina. Bye, Victoria. Goodbye, Solomon.
Can I ask one more
Sure.
exam question? For question 11.
Question 11. Let's see if we can find it. Oh, okay.
So is it like 50,000 plus 12% of annual rate and then divide by 3 months and then
Okay, let's think about, let's see if I can do the whiteboard. I want to try a whiteboard. Open and collaborate. Yeah, okay. Can you see the whiteboard? But I want to erase that. I don't like
Yeah.
that. Okay, see, let's just put it down here. So right here, you have 11-1. That's a timeline. Boy, it's really bad. Okay. That's 11-1. That's when she signs the note. That's the beginning. And the question is December 31. No adjusting journal entries have been made. Oh, that's really horrible looking. Okay. Sorry about that, Sabrina, but it's
It's
the best
okay.
I can do. Let's see. Let's see. Chat. All right. So we have that.
And yeah, can I write how do I do the calculate and tell me
So-
if I was
so-
right?
See, you can try to write on here. Mine's not, it's not taking my finger. You can try to write. See,
Okay. Oh, it's so hard.
it is really silly. Okay. Better. Oh, look how funny I look. Okay. Times 12%, right?
Yeah.
So, and that's how
And
much?
then divided by 3 and multiply
Wait,
by
just
2
do the
months.
12% first. What do you get?
I think it's 6,000.
Are you sure? Is it 600 or 6,000? Maybe 6,000? I don't have a
Yeah,
calculator.
6,000. 50. Yeah.
Yeah, because
wait,
10% would be 5,000. You're right. Okay. So that's
Okay.
it. So interest is always annual.
Okay.
So how much time has gone by between 11-1 and 12-31?
It's 2 months. It's 2 months.
Good. So
Okay, so it's 12. Oh, okay. But it wrote like 3 months, so it doesn't mean anything.
so where do you get the 3 months?
Um,
Oh, no, it
just-
doesn't mean anything. No, it's just as of 11/30, that's 1 month.
Mhm.
And then December 1 to December 31st is 2 months. The note isn't due until probably February 1st. But we don't care. So they've borrowed the money at this point for only 2 months.
Mhm.
Okay. So they're gonna owe $500 a month, right?
Mhm.
Times 2.
Oh, so I thought it means like if the questions wrote like 3 months, no payable means it have to be paid within 3 months.
What it means is the note is due in 3 months. But
But the
since
rate is annual.
the rate is annual always. And at this point, you've only borrowed the money for 2 months. So you only owe for 2 months.
Oh, okay. Okay.
At the
got it.
at the end of January, you owe for 3 months. And when you pay back the loan, you're gonna pay $1,500.
Mhm.
But as of December, you only owe 1,000.
Okay. So 3 months doesn't mean anything. Just
No.
ignore it. Okay.
Ignore it. Yeah.
Okay. Okay. Thank
All
you.
right. All right. We'll see you later. Bye, Joe.